Permanent life insurance is oversold and underdelivers. Myself. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, Certified Financial Planner. Today, we continue our short series on the myths of life insurance, particularly permanent life insurance, and examining the various ways that it is sold and debunking some of those strategies. First, though, the 2-minute tune-in, where we cover the primary points of the podcast in the first 2 minutes. Today, we're going to cover two of the myths of permanent life insurance. Number one, permanent life insurance is a great alternative asset class. Permanent life insurance is often touted as a great non-correlated asset, meaning that it doesn't track with the overall stock market and therefore is a great addition to a total portfolio. It's often also talked about the guaranteed returns of the cash value and death benefits of permanent life insurance, and therefore can be really good in an overall investment strategy. But again, only total return matters. Volatility is irrelevant if properly planned for. And so the fact that you have a non-correlated asset doesn't matter if the total return of that asset is garbage. Plan for total return, not non-correlation. And also when it comes to the guaranteed returns are incredibly low. And everything else about the projected returns is dependent on everything else doing well. We'll get more into that later. And then myth number 2, permanent life insurance is a great way to mitigate taxes. There's a wide variety of arguments along these lines. Most of them involve around the taxability of the cash value of permanent life insurances and also the death benefit taxability. And we'll cover both of those and why it's not the best way to mitigate taxes today on the Retirement Mentorship Podcast. Life Insurance Lies, Part 2. I want to stress again right at the outset that I am calling it life insurance lies because it alliterates, not because most of these things are outright lies. Instead, they're myths or strategies that don't really think about all the alternative strategies that are out there. The point of financial planning is to find the best strategies possible, not to merely find ones that are not terrible. Buying permanent life insurance is not the worst thing you could ever do. Probably the worst thing you could do is to never save anything ever at all and spend all your money until the day you retire. That's probably the worst. And so if you were to stick some money away into a whole life policy for 30 or 40 years until retirement, and that was the only saving you ever did or ever would do, you would be better off than if you had not done that. Permanent life insurance also looks really good when compared to cash or CD rates of returns. But let's not compare it to the terrible things out there. Let's compare it to the best things out there. How does permanent life insurance stack up against truly good financial planning and investment strategies? So we're going to look at 2 more myths today. And number 1 is that permanent life insurance is a great alternative asset class. This myth is purveyed most often by life insurance agents who also purport to be holistic financial advisors. Maybe they also provide investment advice and other investment products. And so they like to paint insurance, permanent life insurance in particular, as part of an overall investment strategy. Look, Mr. and Mrs. Client, we're trying to build you an overall investment portfolio that will perform well and protect you. And just like we will have bonds and cash and stocks, permanent life insurance provides a great asset class to add to the mix. And Mr. and Mrs. Client, here's 2 reasons why. 1, it's a non-correlated asset. So while yes, Mr. and Mrs. Client, we will have a lot of your investments in traditional stock market, mutual funds, and ETFs, when Mr. and Mrs. Client, all of your stocks take a dive and plunge 20, 30, 40%, and you're seeing millions of dollars wiped out in a matter of months, then Mr. and Mrs. Client, you're going to be glad that you have permanent life insurance. It's a non-correlated asset. It doesn't follow the ups and downs of the stock market. It has guaranteed returns so that even when everything else is plummeting, it's still chugging away. It's still going up. No matter what happens, you will have a positive return on this financial tool. And so in your overall portfolio, it's not a replacement for stocks. We're not going to put all your money into this. But in your overall portfolio, Mr. and Mrs. Client, don't you think it would be good to have some of it in a non-correlated asset, some of it in something that is going to provide, number 2, guaranteed returns? There are no guarantees in the stock market. It says that everywhere. Past performance is no guarantee of future success. No matter how much money we put into it or how well we want it to do, there are no guarantees. The stock market's going to do what it's going to do, and that includes going down. So again, as a portion of your overall portfolio, Mr. and Mrs. Client, don't you think it would be good to have some guaranteed returns in that? And that's exactly what this permanent life insurance product is going to do. The cash value in this product is guaranteed to go up every year, no matter what. Even if we hit another global financial crisis, your returns will be positive. So in 2007, 2008, 2009, when everything was careening down and people were losing millions, anyone who owned this product continued to see positive returns every year throughout that global financial crisis and every year since. And so, Mr. and Mrs. Client, that's why we're suggesting this as part of your overall portfolio, to get both a non-correlated asset that's not going to track with the stock market, and also to have some guaranteed returns along with your non-guaranteed growth. And so those are 2 ways that permanent life insurance is sold as a great alternative asset class in overall investing. Some salespeople are probably much better at articulating that than I am, and so you might hear it spelled out a little bit differently, but the overall message is the same. So let's take these 2 things head on as fighting back against permanent life insurance being a great alternative asset class. Number 1, non-correlated asset. I want to stress this again. Only total return matters. Total after-tax return is the only thing that we're after when it comes to investing. Volatility does not matter if you don't need the money. The fear of volatility has been used to sell more underperforming products than anything else. It's a tactic. People want you to be afraid of the market. They want you to be afraid of volatility. They want you to think that temporary declines are the same as loss. They want you to think that the stock market is risky. And we covered that at length in episode 13, What About the Risks? If you haven't listened to that, go back and listen to it. It's critical. If you're 50 years old, planning to retire at 65, and your entire retirement portfolio dips by 20, 30, or 40% because it's 100% invested in stocks, is that a problem? Do you need a non-correlated asset at that time? No, because you don't need the money, and you won't for 15 more years. Do you really think the stock market's going to be down 15 years from now and will not have recovered from where it is now? No, that's ludicrous. It will be back, and if you don't need the money, you don't need something that didn't go down at the time. In fact, if you're 50, you want the stock market to go down. You want it to go on sale so that as you continue to put money into your 401k, into your Roth IRAs, into your invested HSAs, all these different amazing accounts, you want the stock market to go down because then you are buying on sale. If your cash value in your whole life never goes down in value, that means you never have an opportunity to buy on sale, never have an opportunity to take advantage and to outperform. So it doesn't matter if you don't need the money, if you have a non-correlated asset. They can all go down, you can buy all of it on sale, and it'll all come back. We don't know when it will come back, we just know that it will come back. It always has, and as we talked about before, if it doesn't, we have bigger problems on our hands. Okay, but what if you're in retirement? Don't we want non-correlated assets then? What happens if you are 70 and you're retired and all of your retirement portfolio goes down 20, 30, 40%? What happens then? Well, as we've alluded to before, and as we'll talk about more in a future episode, of course that would be bad. Why would you possibly have all your money when you're retired in the stock market? You absolutely want non-correlated assets at that point. You definitely want a blue bucket a war chest, a emergency fund set aside that's not in the stock market that you can pull from when the market's down and wait for it to come back. Absolutely, you want a non-correlated asset. The question, though, is permanent life insurance the right asset for that non-correlated asset? And I would argue no, because of some of the other issues with it. The fact that you have negative returns for decades before it finally starts producing a positive return. The fact that it lacks any flexibility. The fact that the returns are overall very low, and that if you use a different strategy to take advantage of early years and early growth, you can switch over to some non-correlated assets later. If you're in your 20s, 30s, 40s, or even 50s, you don't need to start putting a whole bunch of money away into a non-correlated asset now. Just convert some money over later after you've taken advantage of years or decades of solid equity growth. So yes, permanent life insurance and the cash value therein is a non-correlated asset, and it's not the best asset you could use. There are better strategies and better things you could be doing than using permanent life insurance as your non-correlated assets. You don't need them when you don't need the money, and when you do need the money, there are better non-correlated assets. The next piece of this is the guaranteed returns. People often talk about permanent life insurance and the guaranteed returns on cash value. No matter what, you will always have a positive return. So if you've never been sold a permanent life insurance policy, you may not know this yet, but there are two separate return projections that they will show you in a life insurance illustration. One is the guaranteed returns, what the policy is guaranteed to do, and the other is the projected returns, what they think the policy will do if history repeats itself. Now, when it comes to the guaranteed returns on these policies, they are actually astoundingly low, like terrible. So a lot of these policies, if you look at them and you start putting money in your 20s or 30s or 40s, often you will break even at somewhere between year 15 and 25. And some of the worst policies are even longer. That means just to come back to a zero rate of return, to get as much money out of it as you put into it, takes 15 to 25 years. Let's just focus on the good ones, the ones that break even in about 15 to 20 years, 15 or 16. These policies literally have a negative return. They're guaranteed, yes, and guaranteed to be negative for the first 10 to 15 years. Okay, and then after that, they grow and eventually catch up, and a lot of these policies, the good ones at least, will shake out to be a 4 to 5% projected rate of return over the long term. We're talking 20, 30 years out. These will eventually turn into policies that are producing a 3 to 5% rate of return. The guaranteed returns on these policies, though, are much worse. Many of these, even the good ones, if you follow only the guaranteed returns, won't break even for 30 to 40 years, and after that will produce a 1 to maybe 2% rate of return in the very long term, decades down the road. That's terrible. Why would you possibly want to make 2% over the long term? 2% might be an okay return over the short term, a year or two, but why would you want that to be your rate of return over 20, 30, or 40 years? It's ludicrous. You're talking about giving up tens, if not hundreds of thousands of dollars, depending on your investment, over that amount of time. Don't do it. So yes, there's guaranteed returns on these, but they're terrible. You would never want the guaranteed rates of returns on these products. What is advocated most of the time is the projected rate of returns, what they think the policy will do based on past performance and future projections. That is what's touted. That is what's talked about the most. And so in the same breath, they'll talk about there are guaranteed rates of return on this, and then they'll say, and it's projected to make between 4 and 5%. This kind of can lead people to think that that 4 to 5% is the guaranteed rate. But it's not. It's totally separate. The guaranteed rate is often much lower than the projected rate of return. And then there becomes this double standard when we're talking about this projected rate of return. I tend to believe that the projected rates of returns will happen as long as they're reasonable. If you're projecting that a whole life cash value might eventually end up growing at 4 to 5% after 3 or 4 decades. That will probably happen. The double standard comes into play when agents are willing to think that everything will go right when it comes to these whole life cash value policies, but that nothing will go right when it comes to equity investing. Let's get this straight. For you to get the projected rate of return on the whole life cash value or the universal life cash value in that policy, that means the rest of the global financial markets need to be intact. That means that interest rates need to be high enough, and if interest rates are high enough, that means that equity returns will need to be even higher, because equity returns are always higher in the long term than bond returns or other interest rate products. And so the rest of the global financial economy that supports these projected returns in these cash value policies needs to be intact in order to get the projected return, not the guaranteed return. And if all those other things are going well, i.e. the equity markets are going well, then you should be invested in those instead of in a cash value policy. Yes, there are some guaranteed returns. They're terrible. Yes, the projected returns on these policies are okay and often are better or can be better than bonds or other types of fixed income products. But again, why would you want those if you are still years and years out from needing the money? If you're in your 20s, 30s, and 40s, you should not be wanting low income, low interest rate, low growth products. You should want the highest rate you can get without undergoing unnecessary risk. You should want a broadly diversified, equity-based portfolio. And so when it comes to the risks of investing, look, the only way you're going to get the projected rates of return on the cash value is if everything else is going right. And if everything else is going right, you should have been in equities. Once you get out to retirement, story changes maybe just a tad, but again, these are often oversold and underdeliver, and there are other reasons to not choose a permanent life insurance policy over some of the other fixed income alternatives once we get there. But if you're in your 20s, 30s, and 40s, there's no reason you should be putting away a bunch of money into something that will have negative returns for 15 to 25 years, only to eventually have a long-term rate of return that's much lower than the equity returns you could be getting right now. So again, for 99% of people, permanent life insurance is not a great alternative asset class. It's a great alternative to cash and CDs, maybe, but not a great alternative to a good, broadly diversified equity investment plan that you stick to over the decades. Those will always win out in the end. Always. If you don't have one, get a good financial plan, get a good equity investment plan in place, and stick to it. Myth number 2, permanent life insurance is a great way to mitigate taxes. This is a often touted strategy of permanent life insurance, one that any financial services rep will bring up as a reason to include whole life or universal life or some kind of permanent life insurance in your portfolio, because it's a great way to mitigate taxes. And they'll talk about it on 2 different planes. One, the cash value. Cash value inside a permanent life insurance policy can be taken out at any time for any reason, tax-free. The way you do this is you can do partial surrenders if you want to, and if you have surrender less than you've put into it, then you technically haven't made any money on it, you haven't made any gains, and so that's tax-free. Of course, that's true of any investment. Anytime you put money into a regular taxable investment, if you pull out less money than you put into it, that can also be tax-free. It might even be a loss. But let's ignore that factoid and just keep focusing on life insurance, because that's what I'm trying to sell you today. So, cash value can be taken out at any time for any reason, tax-free as partial withdrawals if it's less, or as policy loans. You can take a loan out against your policy. The money stays in the policy. It's technically not a withdrawal then. It's just a loan, and loans are almost always tax-free, right? When you get a big mortgage and a bank pays you $200,000 or $300,000 to buy a house with, you don't pay taxes on that $200,000. It's just a loan. It's not income, and therefore it's tax-free. In the same way, policy loans on life insurance are also tax-free. You can get at that money and keep your policy in place and borrow against it on a tax-free basis. And so it's a great way to mitigate taxes because you can get it at any time. It's not like a retirement account where a Roth IRA where you have to wait until you're 59 and a half and you have to, can't get at it before then. So you can get it at cash value anytime. And whenever you get at it, it's tax-free. You don't have to worry about spiking yourself into another tax bracket or having to withdraw extra to pay the taxes on it. And so it's just a really great, flexible way for you to mitigate taxes. So let's handle that one real quick before we look at the death benefit taxability. So a few things. As we mentioned before, other non-retirement investments can also be accessed tax-free if you're withdrawing less than you put into it, right? If you put in $10,000 into a whole life policy over 10 years, one, you don't even have the $10,000 left to you yet. So you can surrender that thing, withdraw the whole amount, and get your $7,000 back out of the $10,000 you put into it, and that's tax-free. You got that $7,000 tax-free. Of course, you lost $3,000, but let's ignore that. You get your money tax-free. Or you can take a policy loan against that, and that's tax-free as well, and you don't surrender the policy, and as long as you pay that back, you should be good to go. Again, you can do that with just about anything. Most mutual funds, if you buy those outside of retirement accounts because you still want to be able to access it before 59 and a half, you can put money in there, and if you pull money out at any time and you pull out less than you've put into it, as long as you've keyed it in correctly as a first in, first out, it means you're taking out your contributions first and not your gains. And the contributions will be tax-free when you pull them out because you've already paid the taxes on those. One of the drawbacks of cash value is that if you take out money at a loss, if you have to surrender the policy, let's say that you bit off more than you can chew and you are putting money into this thing, you have to stop and you have to surrender the policy because you can no longer afford the hundreds of dollars a month that you agreed to put into this thing because life changes. And so you surrender it and you put $10,000 into it and you get your $8,000 back and you lose $2,000. So yes, you got your money back tax-free, but you don't get to do anything with that loss. If you'd done the same thing with a mutual fund, put $10,000 into it and had to sell it for only $8,000, you could at least take a $2,000 loss against some of your other taxes. And so in that case, cash value is actually less of a tax mitigation than other types of investments. It's worse for you tax-wise. Another point would be that you should always, if you're looking at retirement income and retirement tax mitigation, be maxing out every bit of Roth that you can do before you would do cash value. Roth is going to be much better than cash value because you're not borrowing against it. You can just take the money out tax-free after 59 and a half. And then you can get equity returns instead of the aforementioned guaranteed and even projected returns of a cash value policy. And this is again where most permanent life insurance is oversold and underdelivers because most insurance agents will recommend that people get whole life before they've maxed out all their Roths. Before they've maxed out 2 Roth IRAs for the couple, before they've maxed out a Roth 401k, any of these other tax mitigating strategies could be used first, but that's not the real goal. The real goal is to sell the policy. If the real goal was tax mitigation, they would recommend that you do all those other things first, but they don't. The goal is to sell you the policy and make the 50 to 110% commission on that first year premium. That is the goal, not to mitigate taxes. First, do Roth way before you do cash value. Even beyond that, again, the goal is total after-tax return. And so even if you can use cash value in a tax-free basis, let's say that you pulled $10,000 out of a cash value policy because that's how much money you had in there and you can take that out at a tax-free basis. If you had done another investment and it had grown to $15,000 and you had to pay $2,000 in taxes and you were able to pull out the remaining $13,000, that's still better than $10,000 tax-free because the after-tax return is still much better. The goal is not to simply minimize the amount of taxes you pay overall. The goal is to have the most amount of money after you've paid taxes. That is a real investment strategy. That is a real financial planning strategy. Not simply to minimize the taxes that you pay over your lifetime, but to have the most money after you pay your taxes. And cash value is not generally the way to do that. The last part of tax mitigation they'll talk about is the death benefit. That the death benefit pays out tax-free to anyone, and that there's never any taxes on that. So it's a great way to pass on assets to your loved ones on a tax-free basis. Again, usually oversold and underdelivers because people will still tout this as a reason for people to buy permanent life insurance when they have not done most of the other things they should be doing. It'll be sold to a couple who is putting away 3% into their 401k and no other retirement savings. How is that the next best thing they should be doing? It's not. It'll be sold to people who are not maxing out Roths, who are not putting enough into retirement, who do not have a basic emergency fund, who do not have the full amount of term. It is oversold in so many ways to people, and they tout this death benefit tax-free nonsense as a reason to get it when there are 10 to 20 other financial strategies you should be doing first before you think about what amount of taxes your kids will pay when you leave them money. How about first, let's make sure that we actually can leave them something before we worry about how it's going to be taxed. But let's say that you've already done all those things. Let's say that you're maxing out all your retirements, that you are running up against the caps in your 401k and your Roth IRAs, and that you're doing everything else right. Is death benefit and that tax-free ability still right for you? This is not most people, but there are some people in this camp. Should then they be getting a tax-free death benefit? Again, what matters is what is the total amount going to your heirs, not the total amount of taxes that they're paying. For example, let's say that you are going to leave them because of the way that you did your financial planning, because you worked with an insurance financial representative for a long time, that when you pass away, you will leave them very little in assets, but you will leave them a $2 million death benefit completely tax-free. Sounds pretty good. But let's say you've done some real financial planning over those decades and you don't have any permanent life insurance and nothing will be going to your children tax-free. But you'll be leaving them $5 million in IRAs. It's going to be 100% taxable, but it's $5 million. Even if they pull all that out and pay 25% taxes on it or 30% taxes on it, they will still be much better off than the tax-free death benefit. Again, what matters is what you leave to your kids after they've paid taxes, not merely the taxes that they pay. And you'll be much better off with an equity-based financial plan than a tax-free death benefit. The only people that this really applies to, that it might be better than, is for people who run into estate tax issues, which you will not run into unless you are leaving more than $11 million per person in a couple to your kids. This means that a couple can leave $22 million to their children before they worry about paying any estate taxes. Doesn't include anything going to charities. If you've got $30 million to leave, you can always leave $8 million of it to charity. That's estate tax free. And then you can leave the remaining $22 million to your kids, and that will also be estate tax free. Again, most people listening to this will not have an estate tax issue, so you don't need a tax-free death benefit to do that. If you are, and you've maxed out literally everything else, and you'll have both income tax and estate tax on assets that you'll leave to your children, the after-tax return on that might be lower than the death benefit rate of return on a permanent life insurance policy. So again, there are very select group that it might be right for. But for the vast majority of Americans, as we said in the first episode, permanent life insurance is not the way to go. Doesn't matter if it's tax-free. What matters is the total amount of money you have either in life or at death after you pay taxes. And the poor guaranteed returns and still somewhat poor projected returns of permanent life insurance policies are not the best way to do that. Get a real financial plan with a real investment plan, and you can beat out these products no problem. That'll wrap it up for this week. Next week, we'll hit a few more of the life insurance lies, the myths and strategies used to sell these products, and why there are better strategies out there. If you have any questions, you can email questions@retirementorship.com, or if you've had any ways that permanent life insurance has been sold to you that you want to make sure that we cover, send us an email. If you yourself own permanent life insurance, continue to listen to these for sure and see if you can uncover some of the reasons why you have it that are also false. And if you have any questions on your specific policy, feel free to shoot that over to us as well, and we can respond to you directly on that. Have a great day, and we'll see you next week. This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retire Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.